Welcome to Psych Insight, where we view the world through the lens of psychology. Today, we'll be delving into the intriguing realm of financial psychology as we explore key chapters from Morgan Housel's book, The Psychology of Money. We will uncover elements of finance that can significantly impact our wealth and financial stability. We'll be breaking down three captivating chapters: Confounding Compounding, Getting Wealthy versus Staying Wealthy, and Tails You Win. Each chapter presents a unique perspective on how we perceive and manage money, from the powerful effects of compounding to the contrasting strategies required to acquire and preserve wealth, and even to the unpredictable nature of success and failure. These insights will equip us with the tools to navigate our financial journeys with a deeper understanding and greater control. So, buckle up as we embark on this financial psychology journey. Firstly, we plunge into the fascinating concept of confounding compounding. This is the principle that small changes can lead to enormous results over time. It's like a snowball rolling down a hill, starting small but growing exponentially as it picks up more and more snow. Compounding is the secret weapon of successful investing, but it's often overlooked because it doesn't offer instant gratification. It's a long game, and it requires patience. The sooner you start, the sooner you'll see the results. But remember, it's not about the immediate returns. It's about the accumulated impact over time. Now, one of the biggest misconceptions about investing is that it's all about earning the highest returns. This couldn't be further from the truth. High returns can't always be repeated, and what if they're followed by a significant loss? Then all that earning amounts to little or nothing. Good investing, instead, is about earning good returns that can be repeated consistently over a long period. It's about the steady, reliable growth of your investment, not the erratic ups and downs of a risky gamble. It's about letting your money work for you, rather than chasing after the next big thing. This is where the concept of compounding comes into play. Compounding magnifies the effect of sustained, steady growth. It's not about making a quick profit, but about gradually building your wealth over time. When you reinvest your earnings, you're not just making money on your initial investment, but also on the returns that investment has already generated. Ignore compounding at your peril. It's not intuitive, it's not flashy, but it is powerful. If you ignore compounding, you're missing out on the potential for your money to grow significantly over time. You're also risking your financial stability by chasing after high returns that may not be sustainable. So it's clear that the magic of compounding isn't just about earning high returns, but earning consistent ones over a substantial period. It's the key to long-term financial success, and it's a principle that anyone, regardless of their financial background or knowledge, can apply to their own investing strategy. Moving on, we explore the subtle yet crucial difference between getting wealthy and staying wealthy. These two concepts, though connected, are not quite the same. Making a fortune is one thing, but keeping it is another game entirely. Now, you might wonder, what's the difference? Well, the process of getting wealthy often involves taking risks, embracing optimism, and seizing opportunities. It's a dance with uncertainty, a thrilling race to accumulate. But staying wealthy, that's a different tune. It requires a blend of frugality and paranoia, a careful balance between humility and fear. Here's the thing, the art of preserving wealth is about survival. It's about holding on to what you've got, even as the winds of fortune blow this way and that. It's not about avoiding risks entirely, but rather about managing them, understanding them, and preparing for their inevitable presence in your financial life. Remember, compounding, that magical financial force we spoke of earlier, only works when you give an asset a long time to grow. But time is a tricky beast, filled with unpredictable factors that can affect your wealth. So how do you navigate this tricky terrain? Enter the survival mindset. This approach to wealth management can serve you well in the real world. It's not just about chasing big returns, but rather about aiming to be financially unbreakable. By being unbreakable, you'll be around long enough for compounding to work its magic, and that's where the real growth happens. But being unbreakable isn't just about resilience, it's also about planning. Not just for the expected, but for the unexpected too. Life has a funny way of throwing curveballs, and your financial plan should be flexible enough to accommodate them. It should have room for error, for the unknown, for the surprises that life inevitably throws our way. And here's the real kicker. To stay wealthy, you need to be both optimistic and paranoid at the same time. It's a strange cocktail, isn't it? But it works. Optimism will keep you moving forward, keep you investing, keep you growing. But paranoia, That'll keep you grounded. It'll keep you cautious, vigilant, and ready for whatever challenges come your way. So yes, you'll make more money over time, but remember, there will be many problems along the way too. And that's okay. Because in the grand scheme of things, it's not just about the money you make, but the money you keep. Therefore, the journey to wealth isn't just about earning it, but also mastering the art of keeping it. Lastly, we dive into the fascinating world of tail events in Tails You Win. Imagine a world where you could be incorrect 99% of the time and still emerge victorious. Sounds perplexing, doesn't it? Well, that's the magic of tail events. In the realm of finance and investing, tail events are those rare occurrences that have a significant impact, despite their infrequency. They are the outliers, the unexpected twists and turns that can either catapult you to success or send you spiraling into failure. Picture this. You're an investor. You make 100 investments and 99 of them fail. But the one that succeeds? Oh, that one hits the jackpot. It covers the losses of the 99 failed investments and even leaves you with a hefty profit. That one success is your tail event. It's the 1% that makes all the difference. But don't be fooled. Tail events are a double-edged sword. They can also be the single event that wipes out all your previous successes. You could be riding high on a wave of profitable investments, only to have one bad investment bring everything crashing down. So what's the takeaway here? Is it that we should all brace ourselves for failure, secure in the knowledge that success is just around the corner? Not quite. The key to navigating the volatile waters of tail events is understanding that they are, by nature, unpredictable and uncontrollable. You can't base your strategy on the hope of a tail event. Instead, you should focus on making sound decisions based on solid research and prudent risk management. And here's where it gets interesting. Some companies, some investors, they build their entire strategy around these tail events. They can afford to take the risk, to experience the failures, because they know that when a tail event does occur, it will more than make up for the losses. But remember, this approach isn't for everyone. It requires a high tolerance for risk, a deep understanding of the market, and the resilience to withstand potential losses. So as we wrap up our exploration of tail events, let's reflect on what we've learned. Success isn't always about being right all the time. Sometimes it's about being right at the right time. It's about recognizing the potential of that 1%, that tail event, and leveraging it to your advantage. But it's also about understanding the risks involved and being prepared for the possibility of failure. Because in the world of tail events, the line between success and failure is often a thin one. So it's not always about being right all the time, but about being right at the right time. As we wrap up our discussion on these enlightening chapters from The Psychology of Money, let's recap the key insights. From Confounding Compounding, we understand that small changes can lead to big results over time, emphasizing the power of patience in investing. In Getting Wealthy vs. Staying Wealthy, we learned that acquiring wealth and maintaining it are two distinct skills, with survival being the ultimate measure of financial success. The chapter Tails You Win showed us the significance of tail events, reminding us that a single success can outweigh numerous failures. These chapters provide valuable insights, not just for those seeking to understand money, but also for anyone interested in the psychology behind decision-making. They remind us that patience, humility, and resilience are as essential in finance as they are in life. Remember, understanding the psychology behind money isn't just about making you a better investor. It's about making you a better decision maker in life. Thank you for watching. If you find this content helpful, please share, like, and subscribe to join our community and stay updated with our latest insights.